So let's begin the third semester's first class of corporate accounting. Now, corporate accounting, as I've already mentioned, is your first honors paper when it comes to the accounting and finance group, which is your group A. And when it comes to corporate accounting, it's quite these first few units, right? Unit 1, Unit 2, Unit 3 also, in fact, they're quite similar with what you've already discussed in terms of financial accounting in your school days, class 11, class 12. We've already talked about these few topics. Okay, so the only thing that we're going to be doing now in corporate accounting for Unit 1, Unit 2, Unit 3 is just dealing in more detail as compared to what you've already done in your school days. Okay, so I'll be handling Units 1 and Unit 2 of corporate accounting, and let's look first at Unit 1, what the contents of Unit 1 are. So when we're talking about Unit 1, under Unit 1 we're having accounting for financial instruments. Now financial instruments, we already know what they are. Okay, we've studied about this under IFS, those different types of financial instruments, financial markets, right? The components of the financial system. So financial instruments include our shares, debentures, bonds, stocks, all those different instruments that are used for trading in the companies, etc. So when we're talking about when we're talking about Unit 1, as we've already said, it is accounting for financial instruments. Under this unit, we'll be dealing with accounting for shares, wherein issue of shares will be decided, including the price band, and then stock investing, bonus and right issue, ESOP, that is employee stock option plan, and buyback of shares. And besides that, we will also be dealing with accounting for preference shares, wherein we'll be dealing with issue and redemption of preference shares. And at the same time, another financial instrument that companies deal with regularly is also debentures. So we'll also be talking about accounting for debentures, issue and redemption of debentures. Now, I'm pretty sure we already have a brief idea on what shares are, right? On what equity shares are, on what preference shares are. At the same time, we also have an idea of what debentures are. So more or less, the method or more or less the accounting transactions are quite similar in nature. So some I'll be dealing with in detail, just as a quick reminder of what we've already studied in school. And once we have a basic grasp of that concept, we'll be moving a little bit faster. Okay, so firstly, let's deal with the theory or the theoretical aspects of the accounting or this unit itself. So when we're talking about accounting for financial instruments are the mostly instruments which are traded in different companies. Okay, so your joint stock company is basically the main organization which deals with shares, debentures as well. Now, you already know about the Companies Act of 1956, I assume, right? We already know about it, and we know that the Companies Act of 1956 talks about a company. What is a company? It gives the definition of a company. It also gives various other definitions related to a company, and we'll only be dealing with those which are actually relevant for this chapter only. Okay, besides all this company laws and all these companies acts and all will be discussed in your common paper, which is business laws. Okay, so let's only deal with those which are relevant for this chapter. Now, a company is nothing more than an association of persons for a business purpose, which is incorporated under the Companies Act. Now, as I've already stated, a company is and a company is an artificial person which has been created by law, and this artificial person has its own identity. It's almost like you and I. You have your own identity, I have my own identity. Okay, so this is what a company is as per the Companies Act of 1956. And a joint stock company is basically a company whose capital is going to be subscribed to by applicants of shares, and it is a corporate enterprise that has a legal identity of its own, which is going to be separate from its members. So you may have 1,000 shareholders, yet at the same time that company does not represent its shareholders. Okay, the company will represent only itself, and the shareholders will represent themselves only. Okay, so like for example, in your classroom, okay, if they say BCom third semester, you all belong to BCom third semester, which means your classroom is representative of you. Okay, whereas in case of a company, like you have Reliance. Okay, let's talk about Reliance. If you're talking about Reliance, the Reliance company is a company in itself, and the owners are not the company. Okay, so if you talk about the owners, you have the various Ambanis. You cannot say that Ambani is the just because he's the owner. Sorry, just because Ambani is the owner of Reliance doesn't mean he can sign off on the papers of the company. Okay, he can sign off on his own assets, but he cannot sign off on the assets of a company because company is to be managed by a group of individuals known as the directors and the shareholders. Okay, so a joint stock company operates as a single unit in the success of which all the members will participate. The joint stock company, the success of the company is due to the efforts of all of the members supporting it. The different members include the directors, the shareholders, the employees, and so on. Now, a company, as you've already said, is an artificial person which has been created by law. Okay, it has been created by law through the different memorandums, through different legislations and registrations. And as such, it cannot exactly generate its own capital because it's an artificial person. Okay, it's not living, it's not breathing. Therefore, it cannot go to people and say, give me money so that I may grow. Okay, so it is unable to generate its own capital. In a sense, it is unable to work in order to get money for itself. Rather, the money for it to grow, the money for it to exist has to be collected from different people. Now, these people who give money to the company are termed as our shareholders. Okay, the people who give money to the company for the company to grow, for the company to exist, are termed as shareholders, and the amount that is being contributed by these shareholders is called as share capital. Okay, so please remember that the amount which is contributed by our shareholders is going to be termed as the share capital of the company, and the share capital is nothing more than the money which the company requires in order for it to grow, in order for it to exist as a whole. So from this, we can see that the term share capital is divided into two words. We have your share and we have the capital. Now, generally, capital is nothing more than money, right? Capital means the amount of money that is to be used in the business or the amount that is invested into a business in order to earn revenue. So basically, we can say capital is nothing more than money invested to earn more money. Okay, and when we're talking about share capital, it is the part of the capital of the company which is represented by the total nominal value of the shares which has issued. Okay, so as you've said, share capital is divided into two words, capital and share. Capital referring to money, share referring to the portion of money that is that has been issued by the company. Okay, a portion of money, share in the capital of a company, share in a portion in the capital of company, as in a portion of the total amount of money that's invested in the business. Okay, that is referred to as share capital. Now, in fact, the Companies Act defines a share as a share in the share capital of a company and includes stock. Okay, so the definition is quite simple, quite silly, in fact, when you look at it, because it just says that a share is called a share in the share capital of a company. Okay, that is how the definition goes. So, from our understanding, okay, from our point of view, we can say that a share is nothing more than a portion of the share capital of a company which is owned by a shareholder. Okay, share in the share capital of a company, and the share capital will also include stocks, different bonds as well. Now, a share is nothing more than an expression of a relationship between the shareholders and the company. Like, you have 10 shares, so let's say you own maybe 10% of the company, or let's say you have 20 shares, then you may own, I'm just throwing around numbers here, then you may own maybe 5% of a company, 1% of company, depending upon the size, depending upon the nature of the company altogether. However, it is to be remembered that a share in the company is a legal entity distinct from the assets that it represents. Okay, just because you own a portion of the company does not mean you own these different assets of a company. Okay, you just own it in terms of money, basically. Okay, so at the end of the day, the company owes you, or the company should pay you back certain it should give you some kind of monetary remuneration. Okay, so always remember, again, a share is nothing more than a share in the share capital of a company. Okay, remember this very silly, very simple definition given to us by the Companies Act 1956. Now, furthermore, moving on, let's talk a little bit in detail about share capital. Now, as we've already said earlier, share capital is that part of the capital of a company which is represented by the total nominal value of the shares which it has issued. So, if a company has issued 10 to 20 shares, let's say a company has issued 20 shares. Okay, so these 20 shares that it has issued, these 20 shares which is allowed by it to be by the law for it to issue, is termed as the total share capital. Now, out of these 20 shares, if you own one share, you become a shareholder. If you own two shares, also you become a shareholder. Okay, you become an owner of the company altogether. Now, the Act, as you've said, it defines a share as a share in the share capital of the company and includes stock, and it's nothing more than an expression of private relationship between shareholders and the company. Now, when we're talking about share capital, in the context of the company law, there are different terms or there are different names by which we can call the share capital. Okay, share capital is in fact subdivided under these different names. Now, the first name refers to as nominal or authorized capital. Now, when we're talking about share capital, the first thing that we should know about is the nominal or authorized capital. So, when we're talking about nominal or authorized capital, this is nothing more than the total capital of the company. Okay, the authorized capital is how much capital a company is allowed to have within it, how much share capital is allowed to have. So, it refers to the face value, or face value is nothing more than the amount stated on the share certificate. Face value is nothing more than the actual cost or the actual value of the share. Okay, so it means when we're talking about nominal or authorized capital, it means the face value of the shares which a company is authorized to issue as per its memorandum. Okay, so remember, every company will have memorandum of association, articles of association, as well as a prospectus. Okay, so the details pertaining to capital will be mentioned in the memorandum of association of the company. And nominal capital is nothing more than the how much capital is allowed to be issued by the company. And under that, the next type of capital we have is the issued capital. Now, issued capital is a part of the authorized capital which is issued to the public for subscription and allotment. Okay, it is issued capital falls under authorized or under nominal capital. And then you have subscribed capital. Now, subscribed capital will fall under issued capital. Out of issued, how many people have accepted or have subscribed to your capital? And then you have called up capital. Called up capital is how much of the shares have been called up for. It is part of the subscribed capital, wherein how much money has been called up by the directors in order for the business to carry on. Okay, how much money has been called for to be paid on the shares that have been subscribed. And then you have paid up capital. Out of the called up capital, how much have these people paid for? And then after that, we also have uncalled capital. And then the uncalled capital, very simple, that amount of subscribed capital which has not yet been called for. Okay, you're just keeping it for maybe later when you need it. Right now you don't need the money, so you'll call later. And then the last one we have here is reserved capital. Now, a company this is only through special resolution. Okay, you may have reserved capital only through a special resolution. If you do not call for a special resolution pertaining to reserve capital, then a company will not be able to keep reserve capital. So reserve capital is nothing more than the capital which you're keeping for reserve, for the bad days, whenever you may need it, mostly in the purpose of it should not be called up for any other purpose except in the event for the purposes of company being wound up. So based on this, you can see that nominal capital is at the top, right? At the top, we have nominal or authorized capital, and under that, we have issued capital. Now, if you have issued capital, there will also be those that have not been issued, right? So, not issued. And then under issued capital, we will be having those that are subscribed, and in certain situations, in case of under subscription, then we'll have those that have not been subscribed. And then under subscribed capital, we'll be having those that have been called up, and under that we also have those that have not been called up. And then in case of called up capital, we'll be having those that have been paid and those that haven't been paid. Okay, so this is basically the classification of our different types of share capitals. Okay, I hope that's okay. And then let's now move on to the next slide. Now let's talk about the different kinds of shares. Of course, I'm certain that you already have an idea of the different kinds of shares that we have, preference shares and equity shares. But let's just go through it as a reminder for ourselves as to what these different kinds of shares are, what they pertain to. Okay, so we know that one kind of one style doesn't suit everybody, right? One food choice or one particular cuisine won't be liked by all of your friends. Maybe you have a group of 5 to 6 friends. Maybe one person like Chinese, another person like Indian, another person like Italian. So similarly, in case of shareholders, also we cannot assume that everybody will want only one category or one class of shares. Okay, as a result of that, to suit the different requirements and mentalities of our investors, company will generally issue different classes of shares. And as per the Companies Act of 1956, the shares of a company can be of two classes only, which are your preference shares and your equity shares. Okay, you only have two classes of shares as per the Companies Act of 1956, your preference shares and your equity shares. So let's talk first about preference shares, see what the different kinds of preference shares are, and let's talk a little bit about their features also as we're dealing with it. So firstly, preference shares. Now preference shares is very simple, are those which have preferential rights or which require preferential treatment. Now in the term preference, it means that we should be number one on your mind. Okay, preference shares means they should have preference, or it should be that it could also be referred to as they should be number one. Now preference shares are those which satisfy certain conditions as per the Companies Act. Now under section 85 of the Companies Act of 1956, there are two conditions which must be met for the shares to be termed as preference shares. So let's look at the first condition. The first condition is that it should carry a preferential right to dividend to be paid either as a fixed amount payable to preference shareholders or an amount calculated by a fixed rate of the nominal value of each share before any dividend is paid to the equity shareholders. Okay, ignoring all the jargon here, the first condition states that it should have preferential right to dividend. So before the equity shareholders are paid for their dividend, preference shareholders should be paid first. Okay, this is what the first point states. Now the second point says that with respect to capital it carries or will carry on the winding up of a company, the preferential right to the repayment of capital before anything is paid to equity shareholders. The second point states that in case a company closes, before any kind of payment is made to the equity shareholders, the preference shareholders should be paid first. Now you know very well that when it comes to the winding up of a company, firstly we have to pay the outsiders, right? We have to pay the different creditors, we have to pay all of our loans, everything else that we owe should be paid first. And once all these outside the third party liabilities, the third party settlements have been made, then we can move on towards the payment of the shareholders. And when it comes to shareholders, in order for a share to be termed as a preference share, it should be paid first before payment of your equity shareholders. That is what is being said in the second point. Okay, so these are the qualifications, or these are the conditions which a share must be satisfied to be termed as a preference share. Now, when we're talking about preference shares, they can additionally be divided into three kinds. Okay, three categories and subcategories as well. Now, preference shares are subdivided into different classes. Now, the first class we can see there is cumulative and non-cumulative preference shares. Okay, these fall under one category. So, cumulative. The word cumulative means to accumulate or to keep on adding. Okay, it's just like a piggy bank where you add 1 rupee, 2 rupee, and then eventually, when it's full, you pay it off. Or when you need money, you can take it out. Okay, so that is what cumulative means, to accumulate or to gather or to collect. Now, in case of cumulative preference shares, if the profits of the company in any year are not sufficient to pay dividend on such shares, the deficiency accumulates to be paid out of the profits of subsequent years. Which means that, for example, if you have preference shares that you have to pay dividend on, let's say you have to pay dividend worth rupees 1 lakh. Now, if the profits of the company in that particular year, let's say they're just rupees 20,000, you don't have enough money to pay, right? You need 1 lakh, but you have only 20,000. So what you do is, you may pay first the 20,000, or you may just take that full 1 lakh and say, I'll pay it for you next year. Okay, I'll pay it for you next year. Now again, if in the next year you still have less amount, okay, you have a deficiency, but you're able to pay them, let's say 50,000, then you can pay out that 50,000 and you can carry forward that amount to the next year. The unpaid amount can be carried forward to the next year, okay, until all the amount has been duly paid off. That is termed as cumulative preference shares. So non-cumulative preference shares will be the exact opposite of that, which means if you're unable to pay this year, it will not be carried forward to the next year. Okay, in case of non-cumulative preference shares, dividend is payable only out of the net profit of each year. So for the dividend of 2021, you can only use the net profit of the year 2021. You cannot use the profit of 2022, 2023, and so on and so forth. Okay, the shares, they do not have the privilege of accumulation of the unpaid dividends. Even if the unpaid dividends amount to rupees 1 crore, if it's a non-cumulative preference shares, it will not be paid in the future. It should be noted, however, that if the preference shares are not described in the articles as being of either kind, they should be treated as cumulative. Okay, which means that if in the articles of association of the company, it's not mentioned whether the shares are cumulative or non-cumulative preference shares, so you must always assume that they are cumulative in nature. That is, that they will be paid in the future in case they haven't been paid in the current year. Okay, that is with regards to cumulative and non-cumulative preference shares. Moving on, we have redeemable and non-redeemable preference shares. Now, redeemable preference shares are those the capital of which may be refunded by the company after a specified period of time. Meaning, if you have subscribed to, let's say, 10 lakh worth of preference shares, okay, after a specified period of time, if you have subscribed to redeemable preference shares, then those shares will be repaid back. Okay, that amount on your shares will be repaid back to you. And non-redeemable preference shares are those the capital of which cannot be refunded before the winding up. Whereas when it comes to non-redeemable preference shares, you will be paid, but not before the closing of a company. Okay, so if a company is existing for 60 years, then the amount that you've invested will also go on for 60 years. Okay, you will not be repaid until the company has finally closed down. That is redeemable and non-redeemable preference shares. And then the third kind of preference shares we have are your participating and non-participating preference shares. Now, when it comes to this particular specific category of the preference shares, it talks about the participation in the decision making of the firm. Okay, it talks about participation in the decision making along with your equity shareholders. So, we can easily explain it as participating preference shareholders or participating preference shares are those preference shares which are entitled to a fixed rate of preferential dividend, and in addition also they enjoy a right to participate in these surplus profits along with the equity shareholders after the equity shareholders have been paid off at a certain rate. So what it means is that they will be able to participate in the profits earned by your equity shareholders. Okay, so besides earning the besides earning the dividend, which is already fixed for them through preference shareholder rights. Okay, besides getting that certain percentage that has been fixed for them, additionally, if there is any excess amount that is there after the equity shareholders have been paid off, if there's any surplus profit, then they are able to participate in that amount, okay, along with the equity shareholders. And but they, of course, they'll not be given any amount. A certain rate will be there, okay, maybe 10%, 5%, 2%, whatever the amount will be fixed by the company. Now, further, in the event of the winding up, if there is any surplus left after paying shareholders and after paying preference shareholders and equity shareholders, then the participating preference shareholders will be getting a certain portion of the surplus of the assets of the company as well, meaning that they will be participating in anything that is surplus. Okay, participating preference shareholders refers to the preference shareholders which will be getting anything in excess of the preferential treatment after equity shareholders have been paid off. Okay, that is referring to our participating shareholders, preference shareholders. Now, when we're dealing with preference shares, after learning about the different types of shares, after learning about the different categories also of preference shares, we can easily say that there are certain features of preference shares. Firstly, preference shares has a preferential right to dividends at a fixed rate. Okay, they will be having preferential right to dividends, but these dividends are going to be at a fixed rate. Secondly, it has cumulative right to dividend. This is from the explanation with regards to cumulative preference shares. And additionally, it also has preferential right to the assets of a company in case of liquidation. In case a company winds up, they will be paid out first before the equity shareholders are paid. And then there is also the amount is also redeemable. The investment is also redeemable after the expiry of a period of 20 years from the date of its issue. Okay, this is in case of redeemable preference shares. Non-redeemable means only when as the company closes down will you get your the amount back. Okay, the amount of investments back. And then additionally, when we're talking about preference shares, they can be purchased or sold in a stock exchange at a price, above below its face value, meaning par, at premium, or at a discount. And a very important aspect or very important feature of preference shares is that it has no voting power whatsoever. It cannot decide, it cannot join in discussions with regards to the workings of the company. And a very important part here, a very important feature of preference shares is that it can be converted into equity shares, or it may not be converted into equity shares. Okay, so under kinds of shares, the last category we can also include is that convertible and non-convertible preference shares. The convertible preference shares refer to those preference shares that should be converted into equity shares after a specific period of time, whereas the non-convertible preference shares are those which will not be converted into equity shares at all, no matter how long their tenure or how long they have existed. Okay, let's move on now from your preference shares. The next category of shares, as we know, are your equity shares. Now, when we're talking about equity shares, very simple. Equity shares are those which are not preference shares. Now, equity shareholders are basically termed as the owners of a company. I hope you know that. I hope you know of this particular phrase, which they always say the real owners of a company are your equity shareholders. Okay, because no matter what a company goes through, the equity shareholders will be the ones who will be able to make decisions. Okay, if there are any excess profits, also equity shareholders are the ones who will be able to get these excess profits. Now, every company must have some equity shareholders. Whether they have preference shares or not, it doesn't matter, but equity shares they must definitely have. Okay, now equity is in fact termed as a risk capital of a company because they are the ones who go through all of the risk. Okay, these equity shareholders are the ones who go through a lot of risk because, as we've said earlier, if there is any profit, they are the real owners, right? As we've said earlier. So if there is any profits, they'll be getting any surplus, and if there are any losses, if in a certain situation, if it arises that there is a profit, let's say, of 1 lakh rupees. Okay, let's say there's a profit of 1 lakh rupees. Now the preference shares they have to be paid of 50,000, and the outside liabilities also have to be paid 50,000. So 50 and 50, 1 lakh rupees goes out already. That means there is no profit at all for your equity shareholders, right? So it's a very risky avenue to become an equity shareholder. You may get profit, you may not get profit. Okay. However, because it's so risky, there is also a high chance of gaining a lot of profit. As we always say, high risk is equal to high rewards, right? So there's also a chance of getting high profit. So for example, if you are getting a total net profit in the year worth rupees 1 lakh, and out of that 1 lakh, let's say you've already paid out everything to your shareholders, your preference shareholders, your outside liabilities, and there is a remaining profit of 50,000. That 50,000 entirely is subdivided amongst the various equity shareholders. So equity shareholders have both high expected returns as well as higher expected risks in comparison to our preference shares. Preference shareholders will always earn a specific or will always earn a fixed amount of returns, whereas equity shareholders the returns may be high, the returns may be low. Okay, so it's very risky avenue. And on the winding up of a company, equity shareholders will receive the surplus, if any, after all of the obligations have been met. So once everybody has been paid off, anything in excess of that, any surplus that is available will be paid entirely to the equity shareholders, whether it's 10 rupees, whether it's 1 lakh rupees, whether it's 1 crore rupees. Okay, everything will be paid out to your equity shareholders. So based on that, we can say that there are a few features of equity shares. Okay, let's go through these features one by one. Firstly, it is a part of the capital of a company. Okay, just like your preference shares, this is also part of the capital of a company, and then it can be purchased or sold on a stock exchange. Additionally, it has no cumulative rights to dividend. If you're not paid this year, doesn't mean it will be paid in the next year. Okay, you're only, as you said, it's very risky. You'll only be paid if there is any surplus profit. And the next point is that it can vote in the election of your directors. As I've said earlier, they are the real owners of the business, and only the real owners can decide whether or not to whether or not these people can work in the company, who can be part of the board of directors. Okay, they are the only parties that can vote in the election of your directors. And then it can take part also in the making of certain important company decisions. While most of the company decision rests upon the board of directors, upon the managers, but then the very important ones pertaining to the use of more capital, because capital belongs to the equity shareholders, right? So most of these larger, more important company decisions will be made keeping in mind will be made by also the equity shareholders. And additionally, it can participate in the profits of the company. As we've already said, any surplus profits will be subdivided amongst the different equity shareholders. And it can also purchase a proportionate part of the future future share issues. That is rights issue. Okay, this refers to rights issue. Now, I'll be dealing with right issue in the future. So just remember that equity shares can also get a proportionate share of your rights issues, and it has a right in the share of the assets upon liquidation. When the company winds up, it has a right to share in the different assets of the company that's available after everybody else has been paid off in the company. So these are your different kinds of shares. You have the equity shares, and we have also our preference share. So moving on to the next topic, which is about issue of shares. Now, a salient characteristic of the company, of the capital of a company, is that the amount on its shares can be gradually collected in various different installments, which can be spread over a period of time. Okay, doesn't mean that you've issued shares, they have to be paid immediately right now. Okay, it's not like we're buying clothes, it's not like when we buy books and all. Okay, it can be paid through a period of installments or a period of time. And we know that when we are issuing shares, we have different calls that we have: your allotment, application, share first call, share second call, share final call, and so on and so forth. Okay, so the first installment is usually collected along with the application and is known as the application money. And then the second installment is collected on allotment and is therefore called as the allotment money. And the remaining installments are collected depending upon when they are called. So they are called as your share call. Now, the first installment that we said as share application. When you apply for the share, you pay for the money. That's why it's termed as share application. And the second call is termed as share allotment. When you have been given the share, when you are allotted a certain number of shares, then you have to pay the next installment. Therefore, it's termed as a share allotment money. And finally, when after that, they'll call on you maybe for when they need money again, they'll call, right? That is why it's termed as your share call. The remaining installments are termed as the share call. And if the final call is being made, if the last installment is to be made, it'll be termed as your share final call. However, this doesn't mean that a company should use maybe 5 to 6 calls. Okay, if they want to get the full money at the time of the application, they may do so. Okay, they may do so depending upon however they feel the need. Now, further, shares may be issued at different prices. We already know these as at par, at premium, or at a discount. At par means face value is equal to the market value. Okay, at par means the the cost of a company, the cost of the share is equal to selling price. Okay, so if you have issued the cost of the share is 10 rupees, you're issuing it at 10 rupees, and that's at par. And at premium means the cost price of the share is going to be lesser than the selling price. Okay, cost price is lesser than the selling price. Cost price or the face value of the share is 10 rupees, but you're selling it for 12 rupees, right? That 2 rupees that is extra is termed as a premium. And then you have shares issued at a discount, wherein cost price is lesser than the selling price. Cost price is rupees 10, you're selling it at rupees 7. That 3 rupees is termed as a discount. Okay, so these are the three methods of issuing of shares. Now, a very important aspect are the legal provisions relating to these issues. So we'll just go through them really briefly, really quickly as well. So firstly, issue of shares at a premium, the legal provisions for which are stated under Section 78 of the Companies Act of 1956. Now, the term premium has not been specifically defined under the Companies Act. So premium basically when just say is the additional money we're getting on a share. So a company can, if a market exists, issue shares at a premium, but it's not bound to do so. If it wants, it can, it doesn't have to do it. Okay, so the legal provisions that a company should follow are when it issues shares at a premium are all stated under section 78. So the first provision is that where a company issues securities at a premium, whether for cash or otherwise, a sum equal to the aggregate amount or value of the premium on those securities shall be transferred to an account to be called as the securities premium account, and is to be shown on the liabilities side of a company's balance sheet under the heading reserves and surpluses. Okay, so if you're issuing a share on premium, let's say premium of 2 rupees, okay, that amount of 2 rupees should also be transferred to an account known as securities premium account, and the same amount should be transferred to the liability side. Remember, it is a liability. Okay, you're earning extra money, but it is to be termed as a liability of a company under the heading reserves and surplus. Okay, and then the next provision under section 78 states that a securities premium can only be used for the following 4 purposes as laid down in section 78. So the amount that you're earning from securities premium, right, we can use it only for these 4 purposes. Firstly, to issue fully paid bonus shares to an extent not exceeding unissued share capital of a company. And second point is to write off preliminary expenses of company. And the third is to write off the expenses of or commission paid or any discount allowed or on the issue of shares or debentures. And the last way in which we can use securities premium is to pay premium on the redemption of preference shares or debentures of the company. Okay, these are the only 4 ways in which you can use the securities premium. Now, these particular theories are quite important, quite relevant also. Please make sure you write them down somewhere so that you can use them in the future. Sometimes questions do arise as to how you can use the securities premium of the particular company. And then issue of shares at a discount. And for issue of shares at a discount, you have legal provisions under section 79 of the Act. Now, if the price required to pay to the company for a share is less than the nominal value of the share, then it's called as a discount. And a company can issue shares at a discount only if the following conditions are satisfied under section 79. So the first condition is that the shares issued at a discount should be of class already issued. Okay, which means that a new company is not allowed to issue shares. Okay, the shares issued at a discount should be of a class that has been already issued, meaning a new company is not allowed. Okay, fresh shares cannot be issued at a discount. Second point is the issue of shares at a discount is authorized by a resolution passed by the company in its general meeting and sanctioned by the company law board. It cannot just issue shares at a discount if it wants to. It has to go through a lot of procedures. They have to the board of the company should first agree to the issue of shares at a discount. And the third point is the resolution should specify the maximum rate of discount at which the shares are to be issued. Now, this particular discount should never exceed 10%. Okay, in special cases, of course, the company may issue the company law board may permit a higher percentage of discount. However, in normal situations, it should not exceed 10%. And then the next point is not less than 1 year has, at the date of the issue, elapsed since the date on which the company was entitled to commence business, which means that the company should have existed for at least 1 year, okay, before it's allowed to issue shares at a discount. And then the shares to be issued at a discount are issued within 2 months after the date on which the issue is sanctioned by the company law board, or within such extended time as the company law board may allow. Okay, so the moment you get permission, within 2 months you must issue, or even if it's extended, so within that period of extension, only then can you issue the shares at a discount. All right. So these are with regards to issue of shares at a premium, issue of shares at a discount. So these are the important theory or theoretical aspects pertaining to the first unit that we have to deal with. And from the next class onwards, I'll be dealing with just small problems only. And then after that, again, any theories and all. So what I'll be doing is, I'll be having theories and then some problems pertaining to the theories I've discussed, and then again theories, problems like that. Okay, I won't just be giving you all theories in full because we might forget them as we move on with problems, right? So theories, problems. Okay, we'll be moving on along that way. So again, as I've said, next class onwards, we'll be dealing with some analytical problems pertaining to what we've already discussed already. Okay, so that's it for this class.